Good evening, everyone.
Good evening, ma'am.
Turn on your cameras, everyone.
Good evening, ma'am.
Good evening, ma'am.
Good evening, ma'am.
Turn on your cameras, everyone, so that I can see you all. I cannot see so many faces. Okay, I can see the students who joined today itself. Please, can you please raise your hands, the students who joined today, not yesterday, were not there yesterday. Please raise your hands from that Zoom. There is this emoticon and there is that option of raise hand. From there, please raise your hands. Okay, Hussein is there. Who else? Parinita, Hussein. Just two students? Sushant, you were there yesterday?
No, ma'am, I just joined today.
You just joined today. So please, whoever joined today itself, not yesterday, please raise your hands from that Zoom function. there is this emoticon and there is the option of raising your hand. Yeah. So that one by one, we can start with the introduction. Okay. Hussain, can you please introduce yourself? From which city you are, and is this your first paper in that way?
Okay. Hi, I'm
Yeah.
Hussein Begwala. I'm from Mumbai, and this is my first paper.
First paper for the
Yeah.
ACCA. Okay. And what are you pursuing other than this?
I am pursuing BAF, Bachelor's in Accounting and Finance.
All right. Okay. First year student?
Yes, I'm in the first
All
year.
right. All right, Hussain. Thank you. Parinita, you can lower your hand now. Parinita, please introduce yourself.
Yes, hello, my name is Parinita Pandit. This is my third subject. I have already passed my BT and now I've done my MA as well. I'll be giving the exam shortly soon. And this is my third paper. I'm also doing BCom in accounting and finance.
Okay. All right, Parinita. And you are from?
I'm from Mumbai.
Mumbai. All right. Okay. Thank you. Prithvi, can you please introduce yourself?
Hello ma'am, myself Prithvi and I am from Karnataka. This is my second paper. I am pursuing BCom and I am in first sem.
Okay. Can you please turn on your camera also, Prithvi?
Ma'am, it's having an issue. That's why yesterday
All
also
right.
checking. I will fix it soon.
All right. All right. Okay. Okay, Prithvi. Shubh, can you please introduce yourself?
Yes, ma'am. Ma'am, I'm Shobh. I'm from Mumbai. I'm currently studying in 11th standard, and this is my second paper.
Okay. You have completed what paper?
No, I'm yet to give it.
Yet to give
BT.
the exam. BT. All right. Okay. Saurabh, please introduce yourself.
Hello, ma'am. Myself Saurav. I am pursuing bachelor's in accounting and finance, and along with that, I have also given my BT exam, and this is my second paper, which is FA. I've also completed MA batch, but I've not yet given the exam.
All right. Okay, Saurabh. All right. Anyone else who joined today?
Yes, ma'am. Me.
Yes, Sushant. Please introduce yourself.
My name is Sushant. I'm from Nepal and going to my second paper. I've already completed business and technology and it's second paper.
Okay. And what else you're pursuing?
I'm currently in a drop year. I haven't started.
Okay. Drop here. All right. All right, Sushant. Anyone else?
Hello, ma'am. My name
Please
is
raise
Sumrit
your
Kaur.
hand. Please raise your hand so that you'll appear on the screen. There is this emoticon function is there. Yeah. Yes, Sumrit.
Hi, ma'am. My name is Sumrit Kaur and I'm from Punjab. And this is going to be my first exam. Along with the ACCA, I'm doing BCom.
All right. Okay. Thank you, Sumrit. Anyone else left for the introduction? All right. All right. So we started our discussion yesterday. We started with the introduction to FR. So whoever joined today itself, can you please watch the recording after 1 hour of yesterday? Okay, because yesterday we discussed a little portion of this introduction to FR, just the basics we discussed. Okay, the basic differences. I'm going to repeat it again. Okay, whenever there is a difference, I'm just going to repeat it. Other than that, please do watch the first lecture recordings. You all. Okay. So let's continue with our discussion. Shall I start, everyone? Please answer yes or no.
Yes, ma'am.
Yes, ma'am.
Yes,
ma'am.
ma'am.
So we started with this introduction to FR. We discussed that what is financial reporting. Financial reporting involves the recording of business transaction in a systematic manner and producing the financial statements from them for the use of the external stakeholders. Okay. Then what are stakeholder? We discussed there were two type of stakeholder, internal and external. We discussed yesterday. And what is our flow of the transactions and the entry? Firstly, there are some certain source document from which we make a entry, initial entry, the journal entry. After that, we prepare ledger accounts. From those ledger accounts, we prepare trial balance, and from those trial balance, we prepare these financial statements. There are 5 financial statements, and one by one we are going to start with these. Okay, this is the first topic for our discussion today. Then we discussed the type of businesses yesterday, that if you want to do a business, there are 3 types. Firstly, you can be a sole trader. Second, you can be a partnership. You can enter into a partnership. And third, you can also form a company. We just discussed the distinction between these 3. Okay. And we also discuss the different type of users or the stakeholders, you can say. There are certain internal as well as external stakeholders. Okay. And now, as I told you, that there are primarily 5 financial statements that needs to be prepared. So we'll start one by one by these 5 financial statements. Okay. Shall I continue? Till here, I don't think there are any doubts. No? All right. So first financial statement, this is our P&L account. Okay, P&L account that we learned in our 11th and 12th. Similar way, we prepare the statement of profit and loss and other comprehensive income. Okay, I'll tell you what are other comprehensive income also. Okay, so this is the first statement that you need to prepare is a P&L account. Okay, the name given in your ACCA studies is a statement of profit and loss and other comprehensive income. We'll call it as SOPL OCI. The SOPL section records the revenues and expenses of a business for a particular accounting period. Okay. For example, the financial year is 1st Jan to 31 December. Whatever income and expenditure you did here throughout the period, you will record it in the SOPL. Okay? Any expense, any income you earned, any expense you incurred during this period, you will write it in your SOPL. Revenues less expenses will give us the profit. What is revenue? Revenue is the sales. Okay. Sales minus, we deduct all the expenses, and this gives us our profit. Okay. This gives us our profit. This is the simple format of your SOPL. Now, what is revenue? Revenue is the income for a period. It is the gross inflow of economic benefits, that is cash or receivables or any other asset, arising from ordinary operating activities. If we have received cash from selling of an asset, that is not our revenue, because that is not our ordinary operating activity. Whatever is the ordinary activity, any asset generated from that, any cash, any receivable generated from that, basically the cash and credit sales, okay, that will be included in your revenue. Such as sales of goods will include sale of goods, sale of services will include the interest, royalties, and dividends. If we are selling it on a regular basis, then these will be included in your operating activities as well. Are we clear, everyone?
Yes.
Yes, ma'am.
All right. Then next is your expenses. So revenue we discussed. Revenue, that is your sales basically. Now what are expenses? Expenses are decreases in the economic benefits during the accounting period in form of outflows. Any expense we incur in order to generate our sales, that expenses will be decreased from your revenue to calculate the profit, or depletion of any asset or incurrence of any liabilities. Okay, any liabilities that are purchases. If we made purchases, that will also be deducted. Even if we made credit purchase, then too it will be deducted. Examples would include your wages, your salaries, your electricity, etc. All the expenses will be included in this expenses. Okay. Now, the important part of this SOPL OCI is the OCI, Other Comprehensive Income section. Okay. So, this section consists of gains not yet realized by the business. How? How is it possible? See, I was having a land of 5 lakh. I was having a land of 5 lakh, which I purchased 3 years back. 3 years back. Okay. 3 years back, I purchased this land of 5 lakh. So, land is a kind of asset that appreciates in value. Yes or no? Yes or no? Yes?
Yes.
So,
Yes,
after
ma'am.
a certain period of time, the value of my land will be increased. So, I should include that increase in value in my books of accounts, right? I should include, na? Because it is an appreciable asset, land. Particularly for land, I can do that. So, what I'll do, if my land gained the value and it became 8 lakh, it became 8 lakh. Okay, I gained 3 lakh. I gained 3 lakh. Yes or no? Yes or no? I gained 3 lakh. Okay. Now, if I'm doing business, my land increased in value. Let's go shopping. I got 3 lakh. Can I do that? Am I receiving those 3 lakh?
No, ma'am.
Am I realizing those 3 lakh? No.
No.
No. Because it is an unrealized gain. This is gain. Gain is there, it is confirmed. Because the valuation is done by some particular valuer or someone, okay, some expert. But I cannot use this 3 lakh until I actually sell my land and get that 3 lakh. Okay? Okay, everyone? So, any such unrealized gain, it is called unrealized gain, okay, shall be included in your other comprehensive section of SOPL OCI. OCI section of SOPL OCI consists of gains not yet realized by the business. For example, the revaluation of an asset, which is not yet sold by the business. We have revalued this asset, revalued this land, and land is still in the business. We have not sold the land yet. Hence, the gain on the revaluation is still unrealized. Hence, that gain will still be unrealized. This is your particular discussion about your revenue, expenses, and your OCI. Just read it quickly. Just read it till here, then I'll go forward. Yes, Gaurav.
Ma'am, can we say that OCI generally consists of non-current assets?
No, not non-current assets. Non-current asset will not be included here, but any gain that we included, that will be taken to your OCI. Okay, non-current asset will be a part of your balance sheet only.
The
All
gain
the
on the non-current assets.
just the gain we can take
Okay.
on here. Yeah. Yes, Neha. Yes, Neha. Turn on your camera also. Yes, Reem, you can ask.
Ma'am, what are ordinary operating activities?
Ordinary operating activities are buying and selling of your inventory. Basic inventory. Yeah.
Ma'am,
Yes.
can you please explain the last paragraph of the other comprehensive sections of SOPL part?
SOPL OCI.
Yeah.
Other comprehensive income consists of gains. These are certain gains. Gains not yet realized. It is not yet realized by the business. These are the gains. Okay. Your land increases from 5 lakh to 8 lakh. Okay. This 3 lakh. This is the gain, but we have not realized that gain yet. That's why it is coming under the OCI section. For example, revaluation of an asset which is not yet sold by the business. When I'm selling that asset, then I can just realize my gain. Okay, till then it would be unrealized.
Okay, ma'am.
Yeah. Or depletion. It is a space in between. It is or space depletion. Yeah, reduction in value. Your depreciation basically. Ma'am, if the land is sold for 8 lakhs after 3 years and it will be recorded for 8 lakh or just the gain, that is 3 lakhs. So see, we already increased our value of land. So we are receiving that only, na? We already just accounted for our gain. So no need to account for that again. The land is at the value of 8 lakh only. And if you are selling at 8 lakh, then it is fine. If you are selling it for 9 lakh, then further gain of 1 lakh. Okay?
Okay.
Neha, any other thing that you want to ask?
No, ma'am.
All right. Okay. You can lower your hand. All right. So let's now go towards the format of the SOPL OCI. So I think there are two students from the science background, Primila and Manan. Are you there in the class?
Yes.
All right. Are you both okay with the discussion that
Yes,
we are
it's
having?
clear.
Even I'm from science background.
Can I know your name, please?
Oh yeah, Snyder.
Okay, Snyder. Okay. All right. So you're fine with the discussion that we're having now, explanation, everything?
So far, it seems simple, but later on I might have an issue.
Yeah, of course. But you have to practice more, as you already know. You have to devote more time. The students who are from the science background, now I can explain you, but after that, the additional thing that you have to do, okay? You have to do more. Okay,
Sure.
all right.
We'll send you more queries.
Definitely.
Yeah. No, we'll.
Yeah.
Yeah. Thank you.
Will?
No, definitely we'll spend more time understanding.
Yeah.
Yeah.
Definitely. Okay. So, statement of profit and loss and other comprehensive income for the year ended 31 December XX. Okay. So, here we are discussing the format of SOPL OCI. So, first thing you have to write is your revenue. Revenue is your sales. Sales, both cash and your credit sale. Okay. Both cash and credit sale you will write here. Okay. Then you will deduct cost of sales. So now, what is cost of sales? What is cost of sales? COGS. COGS. Yes, cost of goods sold, everyone. We learned it. Anyone? Can anyone give me the formula?
Any expense incurred while selling the product, like packing or anything, or
Yeah.
transportation.
Yes. That is
Opening
also
stock
included.
plus purchases
Yes. Opening
minus purchase
inventory.
return
Opening stock
Plus
plus
direct
purchases minus
expenses.
closing stock.
plus direct expense minus closing.
Yeah.
Yes. Plus direct expenses minus your closing inventory. This is the formula for your cost of sales. Opening inventory. Opening inventory, because we are using the opening inventory for incurring that sales. So this is the cost of sales. This is your sales and this is the cost for your sale. This is also the purchases. You are purchasing your inventory only, na? Yes or no? So this is also your cost of sales and your direct expenses. The expenses can you directly link from the production, like your direct material, direct labor cost, direct overhead cost, or the depreciation on the specific machinery that is used for the production process only. Okay. Yes, Fariha, Manha, you're correct. Direct expenses, and then you deduct your closing inventory, because this closing inventory is not an expense for your current year. It will be the cost of sales for the next year. Next year, this closing inventory will become the opening inventory of next year. Yes, yes. So we are not using this inventory. We are not using this inventory in our current year for having the revenue. Yes or no, everyone? Have you understood this concept? It will be repeated. This concept will be further repeated in your inventory chapter as well. But for now, are you clear with the concept?
Yes, ma'am.
Yes, ma'am.
Why we are deducting the closing inventory? Because it is not our cost of sales. It will be the cost for the next year. Yes or no, everyone?
Yes, ma'am.
Yes,
Okay,
ma'am.
so your revenue minus your cost of sales will give you your gross profit. Okay, then if you deduct the distribution cost, further admin cost, it will give you your operating profit. This will give your operating profit. Okay, and then if you deduct your finance cost, that your interest charges, and all the other interest that you are paying. Okay, or if you are okay, sure. Let's discuss the dividend part later. So finance cost is your interest that you're paying. You have taken loan from the outsider. You take loan from the outsider. Yes. To expand your business. Yes or no? So any interest you are paying on that loan will be deducted in your SOPL itself, and then it will give you a profit before tax. And then we deduct the income tax. We calculate income tax. We then have the profit after tax, PAT, for the year. Okay, and we then add the other comprehensive income, that is your revaluation surplus, that is your, in our example, 8 lakh minus 5 lakh. Okay, so 3 lakh will be added here. Okay, so another logic. This 8 lakh, this increase in value from 5 lakh to 8 lakh. Tejasvi, just let me explain this, complete my topic, and then I'll take the doubts. Okay.
Yes.
So our value increased from 5 lakh to 8 lakh. We gained 3 lakh. Okay, we gained 3 lakh. But we haven't realized. So we are not going to pay tax also. No tax will be there on this 3 lakh. Yes or no? Yes or no? That's why after calculating the tax, we then add another logic. Okay? Okay, after calculating the tax on the other profits, we just add a revaluation surplus, and this will be our total comprehensive income for the year. Are we clear?
Yes, ma'am.
Yes, ma'am.
All right.
Yes, ma'am.
Just go through the
Yes,
format
ma'am.
once again. Yes, Tejasvi, please ask your doubt.
Yes, ma'am. I wanted to check if it's a calendar year, right? The financial year, or can it be both?
See, I'll tell you. First read this. I'll just expand. I'll just elaborate on your doubt.
Okay.
Yeah. Yes, Navya.
Ma'am, after calculating the profit after tax, we'll also take into the consideration the revaluation loss as well, or we'll just take revaluation surplus?
Yes, we will. That is your impairment loss. Okay, that is not revaluation loss. It is called as impairment loss. And this is not in your FA. So we are not discussing that. Okay, we are only discussing the upward revaluation of NCA. We are not discussing the downward revaluation because it is not in your course. So I don't want to
So we'll
confuse
just
you.
take the revaluation surplus.
Yes, we will just take the revaluation surplus and no question will be asked on the impairment loss.
All right, thank you, ma'am.
Yes, Hussein.
But ma'am, wouldn't it be depreciation if the revaluation makes the value lesser?
Depreciation of the revaluation.
Like, wouldn't it technically be depreciation because after evaluating the value is going down of the asset, right?
No, we are the value is going up now. 8 lakh from 5 lakh to 8 lakh.
Yeah, but if the value is going down.
If the value is going down, of course, there will be less depreciation.
Yeah. So
Yeah.
then what do we do if it is reevaluating like after evaluation if it is becoming lesser?
After we have done this revaluation, once we have done
Yes.
the revaluation, upward revaluation,
No, I'm saying if the revaluation is downward, then what
impairment
do we do?
loss, na?
Okay, then that is
So
impairment
we
loss.
just, yeah, that is impairment loss. The same, see, we are not treating, but impairment loss, we account for it. Impairment loss, we directly charge. We don't include here. We will directly charge from here
Okay.
because it will be a loss. As per
Okay.
the prudence concept, we account for all the possible losses, but we don't account for all the possible gains. Yes. So by
Yes.
following the prudence concept, we right away just deduct the impairment loss from our SOPL section only. Okay.
Okay,
And
ma'am.
of course, the depreciation will be on the reduced one. But to go for the impairment loss, there is a lot of formulation and a lot of procedures are there to just write down the value in your impairment loss. So we are not discussing that. Yeah. Yes, Tejasvi.
Ma'am, I also had one more doubt. What about the incomes that we receive, like interest from the any investments that we have made, that we get, or if we have given a loan to someone and we get interest for that?
Yeah, so we
What
include
would
it, na? We include it here only, here in this section only. So expenses, you can also include all the other income also. You can just add other income also. It's not given here, but yes, you can add. You can add. There's no specific section. The normal income you can add before your profit after tax.
Okay.
Ma'am, can you
Yes,
just summarize
Mumtaz.
this whole part again?
Yes, I will do that. Yes, Muntasir.
And does revaluation surplus doesn't come under income tax?
Yeah, no, we don't charge income tax on this
So
particular
surplus is
revaluation
not an
surplus.
income.
It is an income, but not realized.
Okay.
Okay, whenever we'll realize, now it will be okay. I'll tell you, it will be a capital gain tax later on. Okay.
Yes, ma'am.
Yeah, because it's a long-term asset, now it's a non-current asset. All right. Anyone else? Any doubt? Okay, I just need to summarize the whole thing. All right. So what happens is in your SOPL OCI, consider as a normal income statement only, normal P&L account. In P&L account, what you do? P&L also you started making in the statement format only. So you write your sales here. So we are writing the sales only, the revenue. Okay, cash and credit both. We deduct the cost of sales from our revenue. That gives us our gross profit. We deduct all the other expenses. Okay, finance cost and everything. We get our profit before tax, and then we deduct the income tax and we get our profit after tax. And then we just add any other comprehensive income, any other unrealized gain, that is your evaluation surplus to it. That is all. Are we clear,
Okay,
everyone?
ma'am. Yes, ma'am.
All right. Now, so Tejaswini asked me a doubt that, okay, here they have written it as the 31st December. So it might start from 1st January only, right? Because 12 months period. Yes, 12 months period. 12 months is the period. Accounting period is same. But year ending is not. In India, we discussed till now, we just learned about two type of year ending. 1st April to 31st March. Yes, or 1st Jan to 31st March. This 2 years we discussed and we accounted for. Here in your ACCA, another difference. Very, very, very important. Very, very, very important. Year can end on any month. Year can end on 31st Jan. A financial year can end on 28th February. A financial year can end on 31st March. A financial year can end on 30th April. And so on. 31st December also. Okay. Had it been ending on 31st Jan, that means it started from 1st Feb. Ending on 28th Feb, that means it started on 1st of March. Ending on 31st March, started on 1st of April. Ending on 30th April, started on 1st of May. Okay, last year. For example, if it's like X9, it is 10. 10, 11. Okay, 11, 12, like this. Okay. So your financial year can end on any month. This is a major difference in your ACCA studies. Very important for calculation of your accruals and prepayments and your depreciation calculation. Very, very important. Okay. Are we clear, everyone?
Yes.
Yes, ma'am.
All right. So this was all about your SOPL, OCI. Just go through it till here. If you have any doubt, please ask. Done, everyone?
Yes.
All right. This was all about your SOPL, OCI. We'll now discuss the SOFP. Okay, that is your balance sheet. We'll now discuss your balance sheet. So the SOFP shows the asset, liabilities, and equity balances of the business at any given date. Again, your financial year is 1st Jan to 31 December. Any asset or liability or equity balance that you are having on this particular date will be included in your SOFP. If you bought any asset, on suppose 1st of Feb, and you sold that asset on 1st of October, that means that asset will not be shown in your balance sheet. Okay? Whatever asset we are having, whatever liability we are having, whatever equity balance we are having on this date will include in our balance sheet. Okay? Are we clear? It shows the accumulated balances of these items from the incorporation of the business. From the incorporation, if we have bought any asset, it will be included. Suppose this is land that you purchased on 1st Jan X5, and you are preparing the balance sheet of 1st January X9 to 2010. That means you have to include this land also, because this land is there at this date. At this date, you are holding this land. Okay? So right from the beginning, whatever asset you are still having on this date, you will include all the asset in your balance sheet. Okay? Just the normal one only. Okay? This is the normal one only that you have done in your 11th and 12th. Nothing new. Okay? All right. Now let's go towards the key definitions. That is your assets. What are your assets? Asset is a resource controlled by the entity as a result of past events from which future economic benefits are expected to flow to the entity. The future economic benefits, they have to flow to the entity. Okay, that means any asset can be your land, asset can be your cash, asset can be your inventory, asset can be your debtors. Anything can be your asset that is controlled by the entity. Entity is having the control over that asset, okay, as a result of certain past event from which a future economic benefit will flow to the entity. Are we clear?
Yes.
Yes, ma'am.
In other words, an asset is anything owned by a business or owed to the business. Someone is owing us some money. Our receivable, our debtor is owing us some money. That is also our asset only. Okay, for example, a car purchased by a business will be the asset of the business. Assets are then classified into two categories. This is also very important from the exam perspective to know this distinction. One is your non-current asset, one is your current asset. If we are holding any asset for the period of more than 12 months, that will be your non-current asset. And if we are holding the asset up to the period of 12 months, that will be your current asset. That is the basic difference. Okay. So non-current asset, generally land, building, machinery, your laptops, your computers, anything that you are holding for a period of more than 1 year will be your non-current asset. And current asset, which can be readily converted to cash within a period of 1 year. That is your receivables, that is your debtors, your bills receivable, your cash. These are all cash or cash equivalents only. Yes or no? Inventory can be converted to cash. They are liquid. They are more liquid assets. Are we clear?
Yeah.
Okay. Non-current asset. These are assets which are used for a long term in the business to generate the revenue. It is not meant to be resold in the normal course of business activities. It can be difficult to sell the non-current asset as they are highly illiquid. We have not purchased the non-current asset to sell immediately. Okay, we are just purchasing such assets to use in the business. Okay, for example, your land, your building, your plant and machinery, you are using these non-current assets for the purpose of generating your revenue. Okay, over the period. Are we clear? The definition. Everyone, please
Yes,
answer.
ma'am.
Yes, ma'am.
All right.
Yes, ma'am.
Now, the
Yes,
current
ma'am.
assets. Current assets are the assets held for the short term. It is usually sold or recovered within a year. They are relatively very liquid. These assets are relatively very liquid and can be turned into cash easily compared to the non-current assets. Example, your inventory, your trade receivable, your cash. You can easily sell these. Okay. I cannot sell, I just go out of my my office and I cannot just sell off my land. Okay, it will take time, but I can sell my inventory. Yes, I can easily sell my inventory. Yes or no? So this is the difference between your current and non-current assets. So please go through the definition of current and non-current and your assets, then we'll go forward. All right. Now, the format of your SOFP. Whenever we talk about the format, SOFP, okay, the asset side, if we talk about, we'll write it as the NCA first and then the current asset. We will write, it is important to note that the assets in SOFP are written in the increasing order of liquidity. So, highly illiquid asset, that is your land. It is very difficult to sell a land. Okay. And your most liquid asset, that is your cash. Okay. We will write it in the order of liquidity. Okay. In this order, we will write your assets in your balance sheet, in your SOFP. That is the asset which is hardest to sell should appear first. So land, hardest to sell, it will appear first. Equity balance will come to it. Okay. All right. So this was about your asset side, and then let's discuss the liability side. Now, liabilities. Whatever is a present obligation, it is an obligation to transfer the economic benefit as a result of a past transaction or events. I purchased some raw material, okay, and last week. So this is a past transaction. For this reason, I have this present obligation to pay money. Yes. So any present obligation to transfer the economic benefit, pay the economic benefit, that is money or cash, okay, as a result of the past transaction or events, would be your liability. In other words, liability is anything owed by. Here we read the word owned by. We own. that asset. Here we owe the money to someone else. Okay, do remember these words will confuse you later on. Right now only just pay attention to the words own and owe. Okay, because in your questions you may get confused. For example, a loan which is to be repaid to the bank, it is the liability that we owe to the bank. Now, okay, one thing I need to tell you, there's a major difference in your ACCA studies and your 11th and 12th. Till 11th and 12th, whatever questions they asked you, they were more concerned about your numerical calculation. Okay, they were more concerned about how you're able to calculate. But here in your ACCA, they want to know that how good you are at interpretation, how good you are to understand the logic of the question. So the language of the questions would be very high. Okay, so practice as many questions as you can, because the language here, we are used to the English that is being taught in 11th and 12th. Now we'll deal with UK English, okay? A bit higher side, you can treat it as, okay? So you see, English is fine. Whenever we are reading, everything is fine. But English combined with your accountancy will trouble you a bit in the beginning, okay? But don't be irritated, don't be frustrated, that is fine. Okay, once you are familiar with the terms, how they formulate the question, how they want you to answer, then it will be fine for you. But initially you may face a bit of trouble. Okay, don't worry, it's normal. So please pay attention to words. One word can change your entire question, and there is a very trick. MCQs are not easy, rather I would say they are hard, because whatever the possible wrong answers you can just think of, they already thought of and included in your options. Okay, so it is not easy, because it's a professional level course. You cannot consider it very easy. Okay, so please take care of a few things. And of course, I am there to help you with all the questions. Don't get scared also, okay? But I'm just telling you that please pay attention to the words here, not just about the numerical calculation. Earlier, we just matched the balance sheet and that is fine for us. No, here we need to understand each and every concept, because they can test you on any concept, okay? Everyone, are we clear?
Yes, ma'am.
Yes, ma'am.
Yes.
Why are you all so silent today? What happened? What happened? Evening tired? Huh? Long day for everyone. What happened to you all today? Speak up. Should not be that boring class now. I should also teach you something. You should also teach me some Gen Z terms. Huh? Last batch taught me Delulu. What do you all want to teach me? Okay? Yes, Snyder?
Ma'am, can you give more examples of very liquid,
Of?
like most liquid assets?
Most liquid asset, see, one is your cash in your hand, cash at the bank. Then more liquid assets could be your check that is being converted into cash in a period of 3 to
Stock
4
can
days
also be
only.
a liquid asset, right?
Yes, that is also a liquid asset only. That is also current asset only. But not quick. Then again there is a differentiation. Current asset and quick asset. Quick assets are your debtors, are your cash. But inventory is your current asset, included in your current asset. So liquid only. Okay.
No, ma'am, I meant like highly liquid. Like you said now, from least liquid to most liquid. I would like to know if there's anything like extremely liquid or something like that.
Extremely liquid is the cash only. See.
Only cash, nothing
See
else.
here, cash. Okay.
Okay.
All right. So let's move towards the categorization of these liabilities. Liabilities are also classified into two categories. Again, the Non-current and current. Non-current more than 12 months. Okay. And up to 12 months would be your current liabilities. Okay. So non-current liabilities, these are the long-term liabilities which are to be prepaid after 12 months of the date of the reporting date of the SOFP. Now, again, 1st Jan to 31 December. Whatever you have to pay within a period of 12 months would be your current liabilities. And after this would be your non-current liabilities. Okay. Within a period of 12 months, if you have to pay, then it will be your current liability. And after 12 months, if you have to pay anything, that would be your non-current liability. For example, long-term loan taken from a bank. Okay. And we will check the reporting date for it. Okay. Reporting date, that is our balance sheet date, our SOFP date. This date will check and will mention the current and non-current accordingly. Current liabilities would be the short-term liabilities which are due for payment within 12 months of the reporting date. For example, your bank overdraft or your trade payables. Okay, bank overdraft. You know bank overdraft? You all know bank overdraft? We can withdraw more
It's
money.
like a
We can withdraw more
current
money
account,
from the
basically.
bank. Current account gave you this facility of bank overdraft. But what is bank overdraft? You can withdraw more money than you have in your bank account. For example, in my bank account, there is just 5 lakh, but I urgently need to make a payment of 7 lakh. So I will just withdraw 7 lakh and 2 lakh would be my bank overdraft balance. Overdraft balance. Okay, bank OD balance. I withdrawn more.
Isn't an overdraft account a separate account?
Yes, two separate account. We write it on the other side, na? That's why it's in the liability. You can withdraw using your same bank account. But in our accounts, we'll write it separate. The bank account, if they are having, then we'll write it in the bank. And if it's a credit balance, then we write as bank OD. Yes, negative balance of your bank is OD. Are we clear? Are we clear till here? Liability section. Just go through it once. Just read it quickly, then we'll go
Yes, ma'am.
forward. Done, everyone?
Yes, ma'am,
Yes,
done.
ma'am. Yes, ma'am.
All right. Next is your equity section of your SOF. Okay. So equity or capital, in case of a sole trader partnership, we call it as capital, but we are using the term equity for our companies, and we are basically doing the accounting for companies only here. So we are using the term equity. Capital is the amount invested by the owners of the business, and the business owes that amount back to its owners. Okay. So whatever is invested by the owners in the business is considered as your capital. In limited liability companies, this amount of investment is divided into transferable shares. Small shares. We divide the entire capital, entire equity into small shares, which form the share capital. Okay. So that is your equity section of your SOFP. Key definitions would be: the conceptual framework defines equity as is the residual interest in a business and represents what is left when a business is wound up, all the assets sold, and all the outstanding liabilities paid. That means in the event of winding up of the company, we will sell off all our assets. Okay, whatever amount we received, we pay off all our liabilities, and then whatever is the residual interest is will be distributed to the equity holders. Okay, this is your conceptual framework defines equity as. If the business stops its operation today, it is effectively what the owners and shareholders of the company would receive after all the liabilities are paid and assets are sold. If the business just stopped working, we'll just sell off everything, and whatever amount is received, we will pay off all our liabilities first, and whatever is left is our equity. Residual interest is our equity of the business. Hence, now the accounting equation would be equity is your asset minus liabilities, or your assets is equal to your equity plus your liability. This is your accounting equation, which will hold true after every single transaction that we enter into the financial statements. In this accounting equation, which holds true in case of the SOFP, that the assets should be equal to the capital plus liabilities from where these sources are funded or bought at any given point of time. That means all of your assets, okay, all of your assets from where you got these assets, either from the capital or equity that is invested in the business, or from the long-term liabilities. Yes, two modes only, na? Yes, if you have the assets, in your business, from where you got the assets, either from equity or from your liability. That's why assets would be equal to your equities and liabilities at any given point of time. Are we clear, everyone?
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
Now, from the perspective of the exam, it is very important to know the format of SOPL and SOFP. The vertical format of SOFP is given as: first you write the assets, and again in the categorization we'll do is highly illiquid at the first and high liquid assets at the end. Okay, so PPE, that is property, plant and equipment, would be written here. After that, we'll write motor vehicle. This is just the instances. There could be so many non-current assets. Okay. Then current assets would be your inventory, trade receivables, bank and cash. That will give you your total assets. Then after that, your equity and liability. Equity, there are fixed 4 components of equity. There are fixed 4 components of equity: your share capital, your share premium, your revaluation surplus, and your retained earnings. These 4 forms your equity section of your SOFP. Okay, this is your total equity. Then you will write the non-current liabilities. Again, the bank loan, the long-term liability would be first, and current liabilities would be coming later on. And then current liabilities, your trade payables, your bank overdraft, like this, and this will be your total of the equity and liability. This total and this total will always match, should always match. Yes, Navya.
But shouldn't we writing equity and liabilities over the asset section?
No, it is the format that we are going to follow.
All right.
Yes, Shreya.
Ma'am, what do we mean by retained earnings?
Retained earnings is all the earnings that we are retained in our business, all the profits of all the years that we are still having in our business, accumulated profits, the total profits.
So they are different from general reserves or they are the same?
No, general reserve is different. General reserve, we include everything. But here we categorized as the revaluation surplus is different and your retained earnings is different.
Okay, ma'am. Thank you.
Yeah. Please go through the format. Please ask if you have any doubt. Done, everyone?
Yes.
All right. Now, we will be reviewing most of the SOFP items in depth. Now, where is the, for example, where are this share capital is coming from where the share premium, revaluation surplus, retained earnings. We'll discuss in so much of depth in for every element of the SOFP. Okay, and so as to how their values are arrived at the different chapters as part of your F3 syllabus. Okay. Remember, in the vertical format of SOFP and SOPL OCI, there is no debit and credit side. Only addition and subtraction happens. We'll just add or deduct. Okay?
Yes.
All right. Then next is your statement of cash flow. Okay? Statement of cash flows. We'll learn about this. There's a separate chapter for it. Statement of cash flows would be all your cash inflows and outflows of the business. Okay, it will be divided into 3 activities: your operating, investing, and financing activities. And we will discuss about all the cash inflows and outflows in this particular statement. Okay, there is a separate chapter that will cover later. This statement shows the cash inflows and outflows of the business, that is the amount it has paid and received throughout the reporting period. The cash flow statement will be explored in depth in the later chapter. We'll discuss the statement of cash flows later on. Okay. So we discussed nearly 3 financial statement. Okay. Your SOPL OCI, your SOFP, and your statement of cash flow. Of course, no in-depth discussion on this. Then there are 2 more left. That is your SOCI and your notes to accounts. Okay. So we'll learn, we'll just discuss these 2 after the break. Let's have a break now. Okay. So
Ma'am,
everyone,
can you please
then
show the statement of cash flow part? I want to mark it.
Statement of cash flow, there is a separate chapter. Was the
No,
chapter
no, no.
number?
This. Right now we did that paragraph.
Balance sheet.
Oh, okay. This one, no?
Yeah, yeah.
Yeah. Done?
Yes, ma'am.
All right. We'll discuss SOCI and the notes to accounts after the break. Okay. And we'll also discuss some regulatory framework after that. And I'll also take you to the LMS section after that. Okay. So let's have a break of 15 minutes. See you all in 15 minutes. It's your choice completely, Hussein, what you want to mark.
Okay, ma'am. Thank you.
Back, everyone.
Yes, ma'am.
Turn on cameras quickly. Turn on your cameras quickly, everyone. Why I can see so many students? Turn on quickly. All right. So, shall we start the discussion of your SOCI? This is a new one for you all. Shall I start, everyone?
Yes.
Yes, ma'am.
Yes, ma'am.
Henel, you want me to slow down my speed?
No, ma'am.
No,
No.
ma'am.
Okay. Henel, can you please tell me what problem are you facing?
Actually, I'm making my notes as well. So, before I complete writing it, the topic gets completed. That's why. Nothing else. I'm understanding the concept, but because I'm making my notes, that's why I wanted you to reduce your speed.
Okay, but I also give enough time in between now so that you can complete. If I reduce my speed now, so it is like accounts. You'll get bored. If I just reduce my speed and teach you very slowly now, that you will just lost only.
Okay, no problem.
I'll wait. If you want to note it down, you can just ask me for more time. I'll wait. No issues in that. If you want me to repeat, then also I'll repeat.
Okay, okay.
I
Thank
can
you.
repeat also multiple times.
Okay, thank you.
If you're not comfortable with the explanation, then I can reduce my speed.
No. Because I'm
No,
making notes, that's why I wanted to.
I'll give you time. I'll give you time. You can just
Okay.
ask for time, okay?
Yeah.
All right. Hussein finds me slow. Okay, Hussein. I cannot go more faster than this.
Ma'am, actually, you are at the right pace.
Okay.
Yes, ma'am.
All right. Chalo. Shall I continue with the SOCI?
Yes,
All
ma'am.
right. Now, statements of changes in equity. As we saw above, there are 4 components of equity. That is your share capital, share premium, revaluation surplus, and retained earnings. These are 4 components of your equity. Now, there is, due to the additional reporting procedure, any changes in these four components will be also shown under your separate statement called SOCI. Okay, so it is equity share capital, share premium, revaluation surplus, and retained earnings, and your total. Okay, so how we will prepare the statement? Firstly, we will write the 4 components. Okay, we will write the opening balance, the balance at the beginning, the opening balance of all the 4. Okay, of all the 4, we'll write the opening balances. Then we will add the profit for the year, that is your profit after tax, to your retained earnings, or if there is any loss, you can also deduct that. Okay, so we will add the profit after tax in the retained earnings, because it will be the earnings that is retained in the business for future. Okay, so we'll add it here in the retained earnings section. Then we will also deduct. Dividend is paid out of profit, na? Yes or no? Dividend is paid out of profit. So we will
Yes.
deduct any dividend paid also from here, from your retained earnings, any dividend that we are paying out from your retained earnings, and then it will be the balance. Okay. Any revaluations during the year will be added to your revaluation surplus. Okay, will be added to your revaluation surplus. Opening balance, we will add any further revaluation that we did during the year, and then it will be the closing balance. During the year, if we incur any fresh issue of shares, so the shares issued at premium, now the shares will always be issued at a premium. Okay, so the share capital, that is your face value of the new issue of shares, will be added to your share capital, and any premium on that will be added to your share premium. In case of fresh issue of shares, you will add that, and then it will be a closing balance. Okay, and that will be the closing balance of your equity. Are we clear with this equity section? This statement is only presented in a limited liability company because the companies will only have equity section. Okay, sole proprietor and partnership will not have any equity section, as it shows the movements in the balances of the 4 primary items of the equity section of SOFP. So the movements of the 4 primary items, as I told you, there are 4 components, 4 items in your equity section. Any movements, any reduction or addition to your equity section will be shown as a separate statement. That is your statement of changes in equity. We call it as SOCI. Any issue of new shares or payment of dividend to shareholders will also be recorded in this statement. We'll also record any new issue of shares or any payment in this particular statement. So this is your SOCI. Are we clear, everyone?
Yes.
Yes, ma'am.
Just go through it. This is also a very important format. Just go through it quickly, take 2 minutes, then we'll go forward. Done, everyone? The science students, Snyder, Manan, and Primala, done?
Yes, ma'am.
Yes, ma'am.
Okay. Any doubt? No?
I have a doubt.
Yeah. Please raise your hand. Yes, so yes, Sumrit.
The reserve surplus under the equity and the reserve surplus under the other comprehensive income are the same thing or are different?
It is the accumulated balance because it includes the opening balance also, and this revaluation, the 3 lakh, it is coming from the OCI section. The addition is coming from the OCI section. This is the opening balance, last year's balance sheet. This is the closing balance, this year's balance sheet.
Okay, thank you, ma'am.
Okay, anyone else? Any doubt? All right. So last financial statement is your notes to accounts. So all the descriptions. Yes, Kamal, you missed half of the class, more than that. It's 9, 10, sorry, 8, 10 already.
Yes, ma'am. Some
You
error
have to
on my
rewatch the,
ma'am. Some error on my LMS. Ma'am, can you
we
tell me
discussed
what's the
the
topic?
statements. We discussed so many things. We discussed a lot today, Kamal. So you have to rewatch the recordings.
You general entry, ma'am, missed it or not?
Journal entry is done. yesterday only, I explained the journal entry. We haven't discussed the journal entries. Today we discussed these 5 statements. Okay. We started the discussion with SOPL OCI, that is your P&L. Okay. Then your balance sheet, that is SOFP. Then we discussed about SOCI, statement of cash flows, statement of changes in equity. And lastly, we are discussing about the notes to financial statement. So you have to rewatch the recording. Okay. Don't miss it.
Okay, ma'am.
Don't miss any of the class, anyone, because it will be continued. Okay. You will miss a lot. If you miss one class, you are missing on a lot. Okay.
Yes, ma'am.
All right. So notes to accounts, they provide the important and detailed information to the users of the financial statement, which is not available in the face of SOPL, OCI or SOFP. Okay. For example, in the SOFP, we mentioned the non-current asset. We wrote it, the property, plant, equipment. Okay. And the entire balance. But property, that is your land, building, plant, your plant and machinery, equipments, your computers and everything summed up in this one amount. So what is the categorization? We will show the categorization here in the notes to accounts. Okay. So they provide the detailed information which is not there on the face of SOPL, OCI or SOFP. The notes provide the breakup of the values on the main on the face of main financial statement. It will provide the breakup of values, that what are included in those values. The significant accounting policies, estimates, judgments of the management in preparation of the financial statement are all included. So anything, any additional information, any particular policy, for example, the method of applying the depreciation, that is straight line method or WDV method, which method we are using, we'll have to mention it in the notes to accounts. Okay. So we'll write here all the significant disclosures that we need to make. For example, your contingent liability, you have to disclose it in your notes to accounts. We'll discuss everything. I'm just telling you the overview of it. Okay. And many such key disclosures required by the applicable standards and law are included in the notes to financial statements. Any additional disclosures, they will all be included here. Are we clear?
Yes, ma'am.
Yes.
Yes, Hussain.
So ma'am, these are usually what we refer to as working notes, right?
Yeah, working notes.
Okay.
Dividend paid. Where do you record dividend paid? In which statement? We
Statement
learned
of
it. No? Statement of changes in equity. So here, now we'll discuss some regulatory things. Okay, the theoretical part, the regulatory framework. Okay, the IASB and the different bodies and everything. We'll just discuss about the UK corporate governance also and Sarbanes-Oxley Act also. Okay, and after that, your double entry system of bookkeeping. So before that, everyone, please tell me, you all have the access to your LMS, right?
Yes.
Yes.
Yes, ma'am.
Yes.
Yes, ma'am.
Have you checked what your LMS looks like?
Yes, ma'am.
Yes.
Yes. Have you noticed that there are 3 sections, section A questions, then section B questions, and your unit test?
Yes, ma'am.
Yes.
Yes.
So have you opened any of the section A, any topic?
Not
No,
yet.
ma'am.
Just
Not
go
yet.
through it. Just scroll it. Just scroll it. I just want you to know, okay? Because after completing this one chapter, you'll be able to complete the questions of that chapter. Okay? So just go through that once, and hopefully tomorrow we'll be discussing a few questions on your LMS. Okay? So that you will also get familiar with your LMS. I'll also tell you that how you're going to study. First, let's just complete with the basics. Okay? The theoretical part is left. Hussain, please contact your mentor. Are you enrolled? Like,
Yeah,
have you
I
completed
am.
your procedure?
Yeah.
Please contact your mentor. Okay.
Okay, I will.
We'll guide
Yeah.
him. Yeah. Yeah. All right. Now, It is important to understand the fact that the preparation of financial statement needs a lot of application of judgments and based on certain assumptions also. Like for example, how to revalue the land. Okay, it is based upon certain judgment, certain assumption, be it the expert judgment, but then too it's a judgment only. Okay, so how to apply such judgments? There are certain standards. For example, you are preparing your SOFP and SOPL in the fixed format only, na? From where it is coming from? Who told? I prepared this format and given to you all. You have to use this only for all the companies. No, there are certain bodies. There are regulatory bodies at international and national level. They set up all the formats and everything for all the companies to follow. Okay. So they also prepared certain standards. Okay. For example, they issued a standard for PPE, property, plant and equipment, that how you're going to value your PPE, what all cost you should include in your valuation, what all you should exclude. Similar way for inventory also, how you can value your inventory, what is your cost, how do you value your inventory. We'll learn about this particular inventory. Okay, standard. So for major components of your financial statements, the regulatory bodies has issued certain standards. Okay, you have to use these standards only to account for or to report your certain items in your financial instruments. Okay, to overcome this issue, that okay, everything is based on assumptions and judgment, to overcome this issue, the accounting standards were developed by different national legislative bodies of respective countries. Every country has their own regulatory body, okay, which issues certain standards that should be followed by every company in that country. For example, the ICI, the Institute of Chartered Accountants of India, is the governing body in India. So ICI is the one that issues the standards that have to be followed by every company for preparing their financial statements. These are the guiding principles for preparing the financial statements, so users are not misguided. Okay, we have a fixed format only, we have a fixed standard only. In that way only we have to present our financial statement. We have to write everything in our financial statements. Okay, are we clear?
Yes, ma'am.
Yes, ma'am.
However, the issues which arose with these were the financial statements of a company in two countries. Now, okay, earlier it was fine. Okay, whatever country regulatory body is issuing the standards, it was fine for that country. But now the companies are trading, are having, the multinational companies are trending now. Okay, so many companies are doing the international transactions. So many companies are having the international branches. Yes or no? So their company, their country's regulatory body will say something else. And for example, one company in India is having a branch in US. So US regulatory body will say something else and Indian regulatory body will say something else. So how to come to a convergence? How to come to a common point? How to come to a common conclusion? There will be the international standards issued by the one international regulatory body. Okay, they came into picture. One international regulatory body was formed by so many different countries representative. Okay, they will form a board. This board is called as IASB. We'll read about it later. Okay, this board, and this board issues certain standards. This board, the international body, issues certain standards, and whatever country, now there is country India, there is country UK, so many countries are there. Now they can just adopt the standards issued by this. Okay, so for India, if we want to adopt the international standards, we can directly, or there is also an option, we can just amend our standards according to the international standards. So India is a country that is not adopting the international standards as it is. India just amended their own standard according to the international standards. Okay, that's why in India we use Ind AS. Ind AS. Have you read about it? The Ind AS, the concept, anyone? You know Ind AS? So Ind AS came from the international adoption only. Okay, in India. Now, however, the issues arose when with these were the financial statements of a company in two countries, let's say USA and India, were presented differently and prepared on the basis of different laws and assumptions. Hence, it became of utmost priority to follow global accounting standards. Okay, so global accounting standards were issued, and that's where the International Accounting Standards Board, IASB, stepped in and developed the International Accounting Standards, that is IAS, and International Financial Reporting standards, that is IFRS. So this international body, that is IASB, is the international body. It issues different standards that are IAS and IFRS. Okay.
Ma'am, but it isn't compulsory to follow the standards made by the International Accounting Standard Board, like for ICAI.
No, it is not compulsory. They can adopt it as it is, or they can amend their own standards.
Okay. So, ma'am, let's say any US company comes in India. So, which accounting policy do they have to follow? Like International Accounting Standard Boards or the ICAI?
It depends on the headquarters now. The company's headquarters are there in USA, right? And they are having the branch.
Yes.
So they have to prepare two set of financial statements. One according to their country, whatever they have adopted, and one according to India.
Okay, ma'am.
Okay. And then there were the tax agreements and all that we'll discuss in tax.
Okay, ma'am.
Okay.
Yeah. Thank you, ma'am.
Yeah. Yes, Susan.
And ma'am, in the example that you just gave, if they don't want to prepare two financial statements, they can just prepare the one from the IASB, right?
Which company?
The
It
company
depends. See,
which
if
has
there are so many exemptions given to companies. Like if there one company that is owned by other company, and that company is preparing the financial statement according to the international one, so that is fine. We can do this, but the tax provisions will be applicable in that company also, which is working in India. Okay, so they will have to prepare even as extract, but they have to prepare. That depends on the categorization or the different company level, what is the turnover. So many relaxations are given to so many companies, but generally we are discussing everything on a general level. Okay, that is, there are international standards and there are international regulatory bodies, there are national standards and there are national regulatory bodies. Okay, these four we are discussing. Are we clear with these four?
Yes, ma'am.
All right. Why there are students still in the waiting room? I'm getting the notification continuously. I'm just admitting it. Why you are joining so late, or what is happening? You're just leaving and joining back. I just admitted Karuna. Karuna, was there a network error, or you joined right now? Karuna, am I audible to you?
Hello, ma'am.
Hello. Yeah, please raise your hand so that it will appear the screen. Yes, Karuna. Were you facing any network issue, or you joined right now?
No, I'm facing network issues right now.
Okay, that's why you rejoined.
Yes, I rejoined.
All right. Okay. So, as of 2020, there are 28 IAS and 17 IFRS in issue. And you should learn about most of them in depth over the course of your ACCA studies. Not everything will come at your FA level only. Okay. Throughout your ACCA course, you will learn about various standards. These global standards enable better financial reporting, consistency, comparability among companies globally, leading to a global harmonization of the accounting standards. So these accounting standards, they are at the international level. So if the companies are adopting those international standards, of course, there will be consistency. They can compare to companies and so many more advantages. Okay. It is important to know that IFRS are not compulsory by law to follow in any country except if a particular country has made it mandate to follow. If the regulatory body of a particular country has adopted and made it compulsory to follow, then only the companies have to follow. Other than that, the international standards are not applicable. Are we clear?
Yes,
Yes, ma'am.
For example, all entities in the European Union must report their accounts using IAS and IFRS. So the countries of European Union, they directly adopted the IAS and IFRS as it is, the international standards as it is. Okay. So all the companies in the European Union countries, they have to prepare accounts using those standards only. Are we clear? Please read it till here. If you have any doubt, please ask. Then we'll go forward. Done, everyone?
Yes, ma'am.
Yes, ma'am.
All right. Next is how the regulatory system works. Okay, who is the regulatory body and how the things work? What is the difference between IAS and IFRS? So see, there are different names given. Some are your international accounting standards and some are international financial reporting standards. It will be financial reporting specific to that. And IAS, it is a general kind of standard. Both are related to your accounting framework only. But this will particularly relate to your reporting and this will be the general accounting standards. Okay. All right. So regulatory system, how the system works and what are the bodies, what are their roles and summarized in the following chart. So IASB is the accounting body, as you know, okay, that its job is to develop the accounting standards at the international level. Okay. Now there is this foundation, IFRS foundation. Okay. It is controlling this IASB body. Okay, and then there is this IFRS Advisory Committee and IFRS Interpretation Committee that is also helping this IASB in determining various standards. I'll tell you how. Okay, first, the IFRS Foundation, the foundation, it is an independent private body that oversees the IASB. It oversees the IASB International Accounting Standards Board. Its aim include improving the standard of financial reporting globally, leading the world to adopt global accounting standards while implementing the shift from national accounting standards. So, the IFRS Foundation, its main objective is to try improving the standards at global level and try to promote the use of international standards globally. Okay, this is job of IFRS Foundation. Are we clear?
Ma'am, can you please explain again? You went a bit too fast.
Okay, so IFRS Foundation, firstly, it is the controlling body of your IASB. Okay, first thing. Second thing, its aim, its objective is to improvise the standard of the financial reporting globally. Whatever the financial reporting standards globally. Yes, Gaurang. Yes, Gaurang. So it is the body that is controlling and governing your IASB, and its aim is to improve the standards, the financial reporting standards globally. One, two, to lead the world to adopt the global standards, to just promote the global standards, international standards globally. Okay, are we clear?
Yes, ma'am.
Yes, ma'am.
All right. Now, the International Accounting Standards Board, IASB, the main role of IASB is to develop and implement the relevant IAS and IFRS, the process by which it developed this is. Now, we'll discuss about the process. Till here, please read. So, IASB, the main role of IASB is to develop and implement the standard. Okay, just read it till here quickly, then we'll go forward. Then I'll tell you how a standard is being developed at the global level.
Ma'am?
Henel, are you okay with the speed, Henel?
Yes, ma'am.
All right. Yes, whoever is asking the doubt, please raise your hand.
Ma'am, it's me.
Yeah. Yes, sir.
Ma'am, what was the full form for IFRS AC? Just the AC part. And for the IC
There is
part.
this committee. There is this committee. See, it is coming. IFRS AC
Oh,
Advisory
okay.
Council and Interpretation Committee. We'll discuss about these.
Okay, ma'am.
Okay. Don't need to write anything. It is all there. Yes, God.
Ma'am, IAS standards was the earlier one standards, I guess, which was produced by the IASC body. Later on, it was named as IASB.
Yes, it was changed, but it is applicable only.
Yeah, we need to follow both IAS and IFRS.
Yeah. Jenny, yes, you can say it's a controlling body, governing body. No need to compare it with RBI. RBI is a national body, national regulatory body for bank, and IFRS is the international body, which is governing IASB so that it can prepare the financial statements. It can prepare the accounting standards properly. Oh, you haven't received the notes yet. So, Henel, you can just read the e-books till then. Till then, you can just read the e-books. Everything is available. You don't have to prepare each and every single line notes. It will be very hectic for you also. Yeah. So now, how a accounting standard that is at the international level, imagine the international accounting standard that is adopted by the European countries. There is so much headache to prepare that particular standard, right? So how it is actually prepared? Now, firstly, the IASB appoints an advisory committee to oversee the developing of new standards. Firstly, the IASB formed. Okay, first, and then IASB just appoints another committee, advisory committee. Okay, to oversee the developing of the new standard. Okay, this committee will particularly oversee new standard only. Okay, new standard. Rest members will focus on the remaining standards, what amendments and everything. Okay, but for new standard, there is a separate advisory committee that is formed by IASB. Now, this advisory committee will help IASB to prepare new standard. Now, firstly, for example, the advisory committee advised the IASB that we need a new standard for provisions. Okay, provisions. So what will happen? It will be a first stage, that is discussion paper. Okay, in this discussion paper, we'll write the provision, we'll mention certain things, and we will keep it open for comments. We'll make this discussion paper open for comments. The discussion paper is discussed within the committee, okay, and made open to public comments. Now, all the public comments are invited. Okay, all the public comments are invited. Public means your national regulatory bodies, they can all comment on this discussion paper. Okay, that this should be done in this manner. We should include this in the standard. Every comment will be there. Then, after concluding all the comments and after including all the important matters, a exposure draft is released. Okay, second stage, you will release an exposure draft. You will include all the priority comments that you find practical to include. You will just include all the amendments in that. Okay, exposure draft is made available to the public to review, to receive their comments again. The comments are invited on this exposure draft also. Okay, and after that, on the third stage, we will issue the final standard. Okay, final standard we will prepare the final standard, reviewed and published if this standard would be published if more than 50% votes are casted in favor of it in the committee. Okay, in this committee, advisory committee, this committee is your advisory committee. This committee will do the voting for this particular standard. Okay, and if more than 50% votes are casted in favor, then we can just make it available to public and we'll just publish that accounting standard. Are we clear with the process of developing an IFRS? Please answer, everyone.
Ma'am,
Yes, ma'am.
Yes.
Ma'am, in the discussion part paper, the comments you told, the public comments, it means the ICAI and the US regulations for accounting and all these will
Yes.
give their
Yes.
suggestions, right?
Yes, yes, yes.
Okay, ma'am.
These can give their suggestions.
Okay.
Any doubt, anyone?
No.
Please tell yes or no. Where is your energy?
No, ma'am, no doubt.
No doubts, ma'am.
No,
Huh?
ma'am.
Please be energetic so that I'll also be motivated. Otherwise, I'll also sleep. All right. Now, IFRS Advisory Council, IFRS AC, as the name suggests, this body advises IASB. It consults with the outside world and takes the opinion of other national and international accounting bodies. Okay, this advisory council will get in touch with all the national regulatory bodies. Okay, what you want? What maybe this IFRS AC may call ICI someday. Okay, what changes you want, what new standards you feel like that we should prepare, like that it happens. Okay, as to what issues they are facing and consider any suggestions they have and advises them to IASB. Okay, they will just advise everything to IASB. They will be connecting with all the other regulatory bodies also. Okay, this is also a job of the advisory council. Next would be your IFRS interpretation committee. See, what happens is now we issue certain standard. For example, for provision, we issued a certain standard. Okay, this will be 2 lines for this particular thing, maybe second thing, second para for this, maybe third para for this. And there can be some ambiguity, some confusion that okay, this para could mean this also and other thing also. Okay, then the interpretation committee will clarify that you should only adopt this particular meaning of this particular paragraph. It will clarify. Interpretation committee, whatever is issued, they will provide further clarification on that issued standards. Okay. The main role of IFRS IC is to interpret the standards made by IASB and see if a different meaning of it can be inferred or any lapses are there in them. Any lapses, any repeated information or any information is there in that standard that can be misinterpreted. Okay, they will just try to find out that. Its role also extend to clarifying to the public if any conflicting interpretations have been made with any previously issued IAS or IFRS. Okay, they will also clarify and they will also read continuously. They will check the existing standards and check for anything. Okay, any other interpretation can be made from this sentence on this paragraph one. Okay, this is the job of the IFRS IC. Yes, Susan.
So, ma'am, they do this in order to prevent anyone from misusing the
Yes.
standards, right?
Misusing the standards, misusing any ambiguity.
Okay.
Okay, they will just clarify and you have to obey that clarification. Are we clear? Take 2 minutes, just read everything. There can be MCQs regarding the IFRS AC, IFRS IC, what is their job, what is included in their role. They can ask you questions like this. Done, everyone?
Yes, ma'am.
Yes, ma'am.
Yes,
Any
ma'am.
doubt?
No, ma'am.
Ma'am, please explain. IFRS IC is the interpretation committee. If any standard is there and you want to further interpret it, okay, if there is any confusion, then IFRS IC will help solving that confusion. That okay, what is this meaning? If we included any word like okay, for example, this is included in any section, that is 50% vote. So there could be 50%, up to 50% also, or more than 50% also. So how do we take? So it will issue clarity, no, minimum 50%. Like that. Okay? Are we clear?
Yes, ma'am.
Yes, ma'am.
All right. Any doubt, anyone else? No? All right.
Not yet,
Then
ma'am.
there is this corporate governance, and then the regulatory framework. We'll discuss about these again, okay, in more detail. IFRS Foundation, IASB, or IFRS, what are IFRS IC, SAC, Standard Advisory, IFRS Advisory. Okay, we'll study everything in more detail tomorrow, okay? And then we'll start with the double entry. So yeah, that is all for today. If you have any doubt, you can ask me.
Ma'am, can you post this PDF in this chat? You can, if you can.
Post this PDF. This
Yes.
PDF is available in your LMS now.
Ma'am, I have checked it yesterday. It's not there.
Wait, I'll just let you know. Or I can also just wait. Is there more students in the waiting room? No, na? All right. I'll just include it. I just sent this PDF, okay? Anything else? Anyone? Oh, I sent it to one particular student. So sorry. I'll give you a summary tomorrow, Sahil, because I want to add further explanation to give you a summary for all the bodies. It's just the two bodies that we discussed. To
Okay, ma'am.
summarize everything, I will need more content that we'll study tomorrow.
Okay, ma'am.
Okay? Yeah. Anyone else? Any doubt? All right. So yeah, that is all for today. Good night, everyone. See you tomorrow. Be on time. Please join on time.
Yes, ma'am. Thank you, ma'am.
Thank you.
Thank you, ma'am.
Okay,
Good
ma'am.
night.
Thank you so
Thank
much,
you so
ma'am.
much,
Good night, ma'am.
Thank you,
everyone.
Good
ma'am.
night,
Thank you,
ma'am.
ma'am.
Thank you, ma'am.
Thank you.
Thank you, ma'am. Bye, ma'am.
Thank you, Fariha. Thank you, Sam. All right.